The world's most powerful economic indicator is signaling a recession is near. I'm going to explain this to you in 3 simple, fast steps. Step number 1, let's look at this through the lens of the banking system and their unrealized losses. Now, most pundits and talking heads that you hear in the mainstream media, what's ironic is they completely ignore the health of the banking system. In other words, they ignore the health of the monetary system and they ignore how money actually plays a role in the global economy and the US economy. So we're not going to make that mistake. Let's start by looking at a chart going all the way back to 2006 to today's date. On the left, we go from negative, that's right, negative 700 billion, all the way up to 100 billion. We've got zero way up here on the chart. This represents banks' gains and losses, unrealized gains and losses. And when we have a red bar going down, that indicates a loss. And we have a green bar going up, that indicates a gain. Again, our zero line is right here. So let's start by, looking at where we are today, or where we were in just the recent past, where unrealized gains on banks' balance sheets, and by the way, this is just in the United States, is hovering right around 700 billion. Right now, to be more specific, we're probably around 550, 600. And you say, oh, well, George, that's no big deal. I mean, the banking system represents trillions and trillions of dollars as far as its size. And you would be correct. But to give you some context, let's just go back in time to something that you might remember. It's called the GFC, the global financial crisis that centered around the banks. Okay, well, what were our unrealized losses back then if today they're between 500 billion and 700 billion? At their worst point, they were right around $100 billion. So this tells you the gravity of the situation that we're dealing with right now. Most people think that, Silicon Valley Bank, Signature, First Republic, that was old news. That was back in March of 2023. But what they don't realize is if you scratch beneath the surface, you see that this banking crisis is nowhere near the end. In fact, I would argue we're in the middle innings. And if you look at the data, I think anyone with some common sense would come to the exact same conclusion. But let me be clear, no matter how scary this chart looks, the unrealized losses don't really matter unless they become realized. Let me explain. Let's assume for a moment you're a bank and you have a 10-year treasury on your balance sheet. And let's say it's yielding 3%. Okay, well, if interest rates go up to 5%, because there's an inverse relationship between the price and the yield, that means the price of what you own has gone down. But it doesn't matter if you don't have to sell. If you can hold that 10-year treasury the full 10 years, then you get 100% of your principal back, plus interest, regardless of what the price does in between. But the real problem comes when or if you have to sell the treasury at a loss. So let's go through some of the reasons why these banks would have to unload some of these assets on their balance sheet, which should take the unrealized losses to realized losses. First and foremost, you guys know this one, Silicon Valley Bank, what happened to them? Deposit flight. So they had all these deposits going to other banks. Well, they can't just send those banks liabilities, which is what those customer deposits are. They also have to send them an offsetting asset. Now, a lot of times that can be settled with credit. I won't go too far into that. We'll save that for a separate video. But for the sake of this video, to keep it super simple, let's just assume that if a bank is sending another bank a liability, they have to send them an offsetting asset. Well, they're not going to be able to send them the treasuries on their balance sheet because those other banks want cash. So they're going to have to sell those treasuries in order to get the cash to give to the banks that are receiving those commercial deposit liabilities to begin with. This is one of the main reasons why Silicon Valley Bank blew up to begin with. But unfortunately, we're not done. There's another huge reason as to why these banks would have to take unrealized losses and turn them into realized losses that, quite frankly, could bring down the entire banking system. Let's talk about funding costs. So a bank's balance sheet has assets and liabilities. In fact, let's look at this bank. When you know it, I just drew one up there. Believe it or not, that wasn't random. So we've got a bank here. We've got assets on the left, liabilities on the right. And again, let's assume they've got that treasury paying them 3%. Okay, well, this works as long as on the liability side of their balance sheet, they're only paying out 1%. So let's say on deposits, they have to pay out 1%. They take that money and then they buy treasuries at 3%. Well, that works. They pocket the spread. They've got a positive 2% margin. All right, but if this is short-term debt, which they have to roll over, let's say every single month, then when the Fed jacks interest rates, their rate that they're paying or their funding costs on the liability side of the balance sheet goes from 1% to 2% to 3% to 4% to 5%. Now all of a sudden, you're in a position just like Norinchukin Bank, the Japanese bank we talked about a couple weeks ago, where on the liability side of your balance sheet, you're paying 5%, assets 3%. That is a negative carry. That means every single month you are losing a tremendous amount of money. Therefore, you have no choice but to sell these assets at a loss and hope that doesn't bankrupt you so you can take the proceeds and buy an asset that actually yields more than the 5%. But you guys know that if you sell an asset for 3% and buy one at 7%, likely that asset that you're buying for 7% is going to be way, way, way more risky than the one that you had at 3%, which creates more systemic risk within the banking system, very similar to what we saw with mortgage-backed securities in 2007, leading up to the GFC. Step number 2. Now let's go over what the world's most powerful economic indicator actually is and what it's telling us right now about the economy. So the economic indicator I'm referring to is, of course, the yield curve. Now, the yield curve has several maturities. You guys know this. We've got everything from a 1-month treasury all the way to a 30-year treasury. And the 2 points on the curve that most people focus on is the 2-year and the 10-year. But we've got to focus on all the points in between because all of them give us different signals. But when they're all doing the exact same thing, they're all giving us the exact same signal. That's the key takeaway here. But most of you guys know from watching my videos, the yield curve, and we'll focus on the 2s and 10s, has been inverted for over 2 years. And usually the stuff doesn't hit the fan, in other words, a recession, hard landing, financial crisis, etc., until the curve is no longer inverted. In other words, when the curve starts to uninvert, that's when you usually see the big, big problems that the inversion was predicting to begin with. So what's fascinating is what happened just the other day with the 2-year and the 30-year treasury. Let's shoot right over to my Twitter feed because I took snapshots of both because this is a really big deal. We start off by looking at the 2-year treasury, which was at 4.457%. Okay, well, let's look at the 30-year. The 30-year, 4.462. So the 30-year treasury was trading the yield slightly higher than the 2-year treasury. This is massive because it shows us that the yield curve is starting to uninvert. It's not fully uninverted or it hasn't steepened out completely yet, but this is always how the cycle goes. Now, if we look at a chart of the 2s and 10s, you'll see exactly what I'm referring to. So we'll zoom in for a moment and we'll look at a 5-year chart. And you can see that the curve, and again, this is twos and tens, inverted initially April 4th of 2022, but then it kind of steepened out a bit and then it inverted and then it stayed inverted. That's usually how it works. Unless the Fed is dropping rates dramatically, you usually don't see the curve uninvert just all at one time in a sustained fashion. Usually it's like you kind of dip your toe in the water and then, oh, well, okay, maybe I'll try that uninversion thing for maybe I'll go back to normal in a steep yield curve. And you dip your toe in the water. Oh, no, the water's too cold. You come back, you put your foot in, and then finally you just dive in. That's usually how the curve inverts, and it's also how the curve usually uninverts. It takes baby steps. And the other day, we saw the very first step in that direction. And if we zoom back out, we can see why this is such a big deal. Let's go back to the late 1980s. The curve inverts, but we don't get the recession, which is that shaded gray area, until the curve steepens out. The exact same thing prior to the dot-com bust, the exact same thing prior to the GFC. In fact, it was the exact same thing even prior to the cerveza sickness. There are no certainties, there are only probabilities. But what these cycles tell us that repeat time and time and time again is that the probability is high that this time it is not different. This time it'll play out the exact same way. But it's not just about the shape of the yield curve. What's far more important is how it's getting to that point. Let me explain. We're going to look at a chart from my good buddy Macro Alf over at the macrocompass.com. These are brilliant visual representations of how the curve can actually steepen because there's more than one way. We can have a bear steepener or a bull steepener. And the two of them give you completely opposite signals about the overall economy. Let's start with a bear steepener. That's when the long end of the curve goes up, the yields at the long end of the curve goes up at a faster pace than the yields at the front end. So let's assume for a moment that the 2-year treasury is at 4.4 and the 10-year treasury, or in this case the 30-year treasury, is at 4.3. Well, if the 30-year treasury goes up to 5% and then the 2-year treasury just goes up to 4.5%, well, that is an uninversion as a result of the long end of the curve, the yields going up at a faster pace. Therefore, a bear steepener. Now, a bull steepener is the exact opposite. That's when the yields at the front end of the curve come down at a faster pace than the long end. So let's actually go to a couple charts of the 2-year and the 30-year, and you guys can see exactly what I'm referring to based on what has happened in the recent past. So we'll start with a 2-year treasury. We'll go to 3-month chart. And let's look at just before May, we were right around 5.04%. But now we're trading at around 4.45%. So that's a decline of roughly 60 basis points. Okay, so what has the 30-year treasury done in that time? Well, the 30-year treasury has gone from, let's say, 4.8 roughly, all the way down to 4.41. So we've had a decline of about 40 basis points. You see, so the curve has started to steepen as a result of the 2-year treasury going down at a faster rate than the 30-year treasury. In other words, a bull steepener. So why are they different? Well, if we go back to the chart that shows the two, if you think through how this plays out, it makes a lot of sense. So looking at the bear steepener, if the financial institutions, we'll go back to the banks, using them as an example, if they see a lot of opportunities to lend into the real economy because the real economy is doing well, then they're not going to buy the safest and liquid assets because they're going to get a better return by lending into the real economy. And by the safest, most liquid assets, I'm referring to treasuries.
So instead of buying treasuries, they're going to say, no, absolutely not. I'm going to use that balance sheet capacity to go lend to that business that's creating more goods and services because I'm going to get a higher yield. So therefore, there would be less buying at the long end of the curve. That means the price goes down, yields go up. So in a bear steepener, usually this tells you that the health of the overall economy is improving. It's getting better. But then you have the opposite where the banks look out into the real economy and they say, absolutely not. We are not lending because the risk reward doesn't make sense. And usually you start to see the 2-year treasury go down at a faster rate, just like we're seeing right now. But then what normalizes the curve longer term is the Fed dropping rates, the Fed funds rate dramatically to respond to whatever crisis or situation that we have that leads to the inevitable recession or hard landing. And to be very clear, what we are seeing right now is the bad steepening of the curve, not the good steepening of the curve.
Step number 3. So now we have to ask the question, is the probability highest that we will see just a mild garden variety recession or a hard landing? Something like we saw in 2008, 2009, called a GFC 2.0. Well, my base case is we will see a hard landing for a variety of reasons, but one of the main reasons is because of the banking system, the monetary system, and how money impacts the economy. Let me show you what I'm referring to. Let's start off by looking at a bank. We've got assets on the left, liabilities on the right. And we've got everybody's favorite whiteboard character, Moody the millennial. I have to laugh every single time I draw that up on the whiteboard. And their blue hair. Of course, their because I do not know their preferred pronouns. So Moody goes to the bank and says, hey, bank, could I get a loan? And they say, okay, well, do you have a job? And they say, no. And so the bank looks at Moody and says, Moody, not only do you not have a job, but the yield curve has been inverted for like 2 years. We see massive amounts of risk, and now we have this bull steepener. So there's no way that we're going to give you a loan. The risk reward doesn't make sense. We're going to use that balance sheet capacity for something else. So Moody is completely out of luck for the time being. So what does this mean about the broader economy or money? Well, no money was created right there, because we have to understand that money nowadays, especially the dollar, isn't really printed into existence. It's actually lent into existence. The majority of dollars around the world are lent into existence. This is why you always hear people say we have a debt-based monetary system. Let me explain further. So let's assume for a moment Moody actually gets a job. Congratulations. Let's say Moody is actually the most recent DEI hire for the Secret Service. That's right. Now, Moody has no experience whatsoever, but they do identify as, what would the term be? Non-binary. And oh my goodness gracious, does the government love that? They can check that off their DEI box and say, look, 10% of our employees identify, well, they don't even identify as a gender. That makes it even better than identifying as male or female. Well, Mr. Secret Service person, are they any good at their job? Oh, that doesn't even matter. The fact is they have blue hair and they don't know what gender they are. That's the only qualifications they need. So Moody gets a fantastic job at the Secret Service, making $250,000 a year. That's right. So they go back to the bank and say, hey, look, Mr. Bank, I've got this incredible job right now, and I want to go out and buy a home. So the bank looks at their job with the government and says, yeah, that is absolutely secure. There's no way you can get fired no matter how bad you are at your job. So we'll go ahead and give you a loan to buy that house for, let's say, $500,000. So we have to look at the changes to the balance sheets that are involved in this transaction. So we've got the bank Now, all of a sudden, they have a deposit liability, the same deposit liability we were talking about in step number 1. But to Moody, that is brand new money that they didn't have before that they can use to go out and buy a house. So now, all of a sudden, on the asset side of Moody's balance sheet, they have $500,000. Now, of course, they have that loan on the liability side for the exact same amount, and that loan is the asset that was created by the bank lending those dollars into existence. This is how a debt-based monetary system like the one we have works. You might not like it, but the bottom line is we have to analyze the probabilities of what's going to happen in the future based on the system we have, not the system we want. The problem starts when the banks start lending a lot less due to that increase in risk that we've been talking about pretty much throughout this entire video. Now, most people would say, well, if the banks are lending less, then people are saving more money. I mean, that's just a good thing. Well, in a way it is from a moral standpoint, or maybe from the standpoint of a system that was much, much different. But in that debt-based monetary system, if bank lending goes down, then the money supply is also going to go down. It's going to put downward pressure on the overall money supply or supply of dollars. Maybe currency is a better way to say that. So usually, especially from an Austrian standpoint, that wouldn't be a problem because all prices would simply adjust downward. The price of wages and the price of goods and services. But we have to think through this, again, based on the system we have, not the system we want, such as a gold standard or maybe a Bitcoin standard. And in this system, we still have the outstanding debt. Let's walk through how this works. So Moody goes back to their job and they get bad news because the money supply is a lot lower. Well, they don't know this, but what's happening is their funding is being decreased by the overall government. So they have to cut Moody's wages from $250 down to $100,000. Now, this isn't that big of a deal because we have experienced overall price deflation, let's just assume this is true in the United States, to the point where their purchasing power, making $100,000 a year, is the exact same as $250. So it's just simply yesterday, to buy that Coca-Cola, it cost you $1, and tomorrow it cost you 50 cents, but your wages went down by 50%. It's not going to impact you because the cost of that can of Coke went down by the exact same amount as your nominal wages. The problem there is if you have debt, which we know is how the money got created to begin with. You see, Moody's loan payment, if they borrowed $500,000, is, let's just assume, around $2,000 a month, which they could afford if they're making $250. But now that they're making $100,000, although the purchasing power relative to goods and services hasn't changed, their purchasing power relative to their debt payment has absolutely changed. And therefore, Moody defaults on the bank. This makes the banking system more fragile, risk increase, and incentivizes the banks to lend a lot less than they were lending to begin with, which resulted in the hypothetical decrease in the overall money supply. And if you're sitting back and saying, George, that is absolutely impossible, that the money supply in the United States, the monetary aggregates, let's just say M1, M2, ever go down. Well, unfortunately, you would be wrong. Editor, go ahead and throw up charts going back to 2022. Not only has M2 and M1 gone down, but it's the first decline in M2 we have seen literally since the Great Depression. So now I know a lot of you right about now are saying, okay, George, I get what you're saying here, kind of about the overall prices. I understand that the money supply, it just puts downward pressure, upward pressure. There's a lot of variables that go into this, but the overall concepts I get. But what I don't understand is how all of this leads you to a base case of hard landing instead of mild recession. Well, the best way I can illustrate why this is my base case, is by actually looking at the Tour de France. That's right, the bicycle race that's happening, or I don't know if that's the correct terminology, but the bike race that's happening right now. Everybody has heard of the Tour de France. Now, back in the 1800s, the banking system was very similar to a bike race where the riders are spread apart. So if one of the riders, let's say, gets a flat tire and crashes, it doesn't really impact all of the other riders. In fact, while I'm describing this, if you haven't already done it, editor, let's throw up some visuals of actual races so people can see what I'm referring to. But then in the 1950s, the banking system became far more interconnected. In fact, money itself just became commercial bank deposit liabilities. In other words, dollars were simply a network of banks' balance sheets. So in this case, we have a Tour de France type of race where instead of the riders being completely separated, now they're kind of bunched up in areas. So if one rider goes down, it takes out, let's say, 5% of the other riders. But now the system is completely interconnected to the point where it's almost one aggregate balance sheet. And we could see that starting with long-term capital management in the late 1990s. This was just a hedge fund, for heaven's sakes. But the central planners thought they had to bail them out because if they didn't, it would bring down the entire financial system. And then fast forward to the GFC. Let's remember, the catalyst was just the collateral going bad. In other words, it was the mortgage-backed securities going from a default rate of right around 2%, not up to 20, not up to 30 or 40 or 50%, but only going from about 2% to 6%. That's what caused the entire house of cards to come crashing down. Why? Because it was so fragile and interconnected. And now it's even more extreme to the point where it's like a Tour de France race where every single rider is millimeters apart from one another. So if one of them goes down at the front of the pack, it takes out the entire group. And if that group of bike riders is basically responsible for providing the money for the debt-based monetary system that fuels the overall economy, if there's a problem with the bikers and they all go down, the economy is going to go down with it. So then the next question becomes, okay, George, what do I do about it? Do I buy gold, Bitcoin, bonds, stocks, Nvidia, real estate? How do I protect myself? In fact, how do I not only survive, but how do I thrive, whatever we're going to see throughout the rest of 2024 going into 2025? Well, unfortunately, I can't give you any personal investing advice, but what I can do is tell you what I'm doing in my own portfolios. So this Friday, 2 p.m. Eastern, I'm going to do a webinar in Rebel Capitalist Pro. This is the investment membership site that I have with my good friends Lynn Alden and Chris McIntosh. And this Friday at 2 p.m. Eastern, I'm going to be going over exactly what I am doing with my own money, my own personal portfolio as a result of everything that we're seeing with not only the yield curve, but all these powerful economic indicators that right now are giving us warning signals. So if you want to join me, you can go to georgegammon.com/pro and sign up for a $1 1-week trial. And even if you're watching this after Friday, it doesn't matter because a recording of this webinar is going to be in the Rebel Capitalist Pro forum that you can access at your convenience. So go to georgegammon.com/pro and sign up for that $1 trial right now. And I will see you this Friday at 2 p.m. on the webinar in Rebel Capitalist Pro.